Joe O'Brien from the Howden Group. Can you talk a little bit about the evolution of your market and how M&A insurance has really only come into the fore in the last 5 years or so?
Hi, Denise. Sure. So M&A insurance has been around for approximately 20 years or so, but as you mentioned, it's really come to the fore in the past 5 years. I think, if you look in the past, what happened is that either sellers gave warranties or management gave warranties and retained liability for them, or they gave those warranties, retained liability, and took a sell-side insurance policy. Over the past 5, maybe 6 years, those policies are now placed predominantly with buyers. And that's completely changed the dynamic of transactions, because a buyer takes an insurance policy and those sellers or management, whilst they're still giving the warranties, they usually have a liability cap of as little as £1 or €1. So effectively, they're exiting those transactions with limited liability. Once you have that dynamic in a transaction, sellers are always going to want to exit on that basis, because if you think of a private equity fund, they've exited an investment, they've made some money, they want to divest that and get it back to investors. Actually, if they've got long-term liability due to the warranties, it's a struggle for them to do that. So this product has really facilitated clean exits from sellers. I think that's why it's really come to the fore.
And what percentage of M&A transactions would you say take out insurance at the moment?
I think, from what we've seen anecdotally from our own data and from speaking to advisors in the space, that getting on 50% of deals are now being insured across Europe. And there's probably a little bit of there certainly is a bit of jurisdictional difference there. So the UK, Netherlands, Nordics, and Germany take insurance probably on actually more than 50% of deals where private equity are involved. In France, for example, and Belgium, that number is certainly less.
And what are people actually insuring against? Can you give us some examples?
The premise is that the policy will cover the entire suite of warranties that a seller will give to a buyer under an underlying transaction document. So we do see the full suite of issues that you would secure warranties for being insured. However, when it comes to claims and the things that we're seeing buyers seek recourse for from the insurers, it's matters around financial statements, tax, and material contracts. And actually, those three issues constitute approximately 70% of the claims we see under these policies.
And at the beginning of the pandemic, there was a lot of talk about COVID-19 exclusions, especially in the travel industry. Did this seep into the M&A market at all?
It did, yes. I think there was two broad camps of insurers with respect to COVID exclusions. The ones that would say they would underwrite it and see if they were actually, it was really a risk to the underlying business, and those that would put in an exclusion irrespective of what the underlying diligence findings were. I think that was the case back in March, April. Today, we're actually seeing most insurers fall into that former camp, i.e. people are willing to underwrite and see if they need to apply an exclusion. And I would actually say now we've actually stopped seeing COVID exclusions in our policies. However, there are some specific concerns, and particularly in the UK, the coronavirus job retention scheme compliance and whether companies have actually complied with that or not. That's an area that insurers are looking at in a lot of detail now, especially if a large portion of the workforce are or were furloughed.
And lastly, are there any developments that you are waiting on the horizon in your market in the next 12 months?
Sure, yeah. So we're seeing insurers cover a broad array of known issues. And that's been happening over the last 5 years, but more recently they've been covering higher risk known issues. So by way of example, we're now in the process of putting a policy in place for a known tax issue that's actually under audit by the relevant tax authority in the jurisdiction in question. 2 years ago, no one would even have looked at that. So it just shows where the market's going. I think the two other areas are synthetic warranties, in particular on P2P transactions and distressed acquisitions, and also putting in policies for secondaries transactions. We've actually developed a product over the past 12 months, which we've taken to the secondaries investors and actually seen a lot of appetite from them to take this insurance on their transactions as well.
Joe O'Brien from the Howden Group, thanks very much.
Thank you.